Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent FOMC and discuss the implications in the markets. And we're also going to take a look at a couple other things. We got some other macro data today that we'll take a brief look at. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, more than a year ago, we said that the terminal rate would likely be around 5.5%. And it certainly was not a popular view back then. But here we are, right, at 5.5%. And as we get more and more meetings where the terminal or where the Fed keeps the rate at 5.5%, you really have to wonder, is this not the terminal rate? I mean, back then when rates were at like 2%, I was sort of just throwing a number out. I just wanted to see it get above CPI, and I thought 5.5% would do the job. But now that we're at 5.5%, we must constantly ask ourselves, well, is that the terminal rate or not? And does the Fed have a reason to hike beyond this? Now, if you look at the most recent report, you can see that the Fed decided to keep, again, the Fed funds rate at 5.25 to 5.5%. So going and looking over here on this chart, what you'll see is that they keep not raising, right? But they keep leaving it open to potentially raise in the future, right? They're not advertising a pause per se by they're constantly saying, hey, there might be another rate hike. And in the SEP, the Summary of Economic Projections, at the last FOMC, they sort of insinuated that there would be another rate hike this year. But the market doesn't believe them. And to be completely honest, I don't blame them. I don't really know that I believe I don't really know that I believe them either. And even so, it did seem that Powell tried to downplay much commentary on the prior SEP and another rate hike, right? And if you go look at what markets are expecting, basically at the December meeting, which is only about 6 weeks away or so, there's an 80% chance that the Fed just holds at 5.5%. And I mean, there's a 20% chance, of course, that they hike, almost a 25% chance that they hike in January. But you can see that the market is still suspecting that rate cuts are coming starting in summer of 2024, in June of 2024. Now, again, you should not take this as sort of the answer to what has to happen. I mean, the bond market has gotten plenty of things wrong over the last couple of years, especially if you think back to when rates were at 3%. It's not like the bond market thought that we were going to 5.5%, but yet here we are. So in the short term, at least right now, right, the market thinks the Fed is done. And to be completely honest, I kind of think they're probably done hiking too. I mean, the only way I think that they hike further is if it becomes apparent that this policy is not restrictive enough. Okay, so that I think is the hard part to figure out is have they reached sufficiently restrictive levels? Now, Powell seems to think that they probably have, but he did go on to make some other comments that just listen to some of these comments because some of them seem a little contradictory, right? So one of them, he says, the stance of policy is restrictive, but he also says our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. And we're going to talk about whether that's true or not. He goes on to say later, though, when a reporter asks him, you are not yet confident that financial conditions are restrictive enough to finish the fight. And he says, yes, that's exactly right. So he's basically saying, monetary policy is restrictive and it is putting downward pressure on the economy and is putting downward pressure on inflation. And so then the question is it enough to really slow inflation down, slow the economy down, so that inflation can sustainably get back to that 2% level, which is, of course, their goal. Because as it stands right now, inflation is still running relatively hot. If we were to go just pull it up really, really quickly, just so we can kind of have it in front of us, if you were to look at inflation year over year, you can see that it's back to about 3.7%. If you were to look at core inflation is at is at 4.1%. So if you didn't, like, let's say a year ago, if someone told you that in November that we would get Q3 GDP or we got it back at last month, but that we would get Q3 GDP annualized coming in at 4.9% and core CPI is at 4.1%, do you think the Fed has raised enough? And the answer would probably be no, right? I mean, if you told someone, hey, real GDP or GDP is at 4.9% annualized, and core CPI is over 4%, do you think the Fed would stop there? The answer would probably be no, right? The answer would probably be no, and you probably say no. They probably need to hike more if that's where this stuff is coming in. But the Fed's not, right? They're not. And again, I'm leaning in the direction that, and I could easily be wrong about this, right? But I'm leaning in the direction that this could very well be the terminal rate. If you look back to the last business cycle, you can see once they hit the terminal rate in December of 2018, they held it there through June of 2019, right? So they basically held it there for about half a year or so. This one so far has been held for about half that amount of time, right? So about 3 months or so since the terminal rate was reached, the theoretical terminal rate. So then the ultimate question is, has the Fed done enough? Because we saw last quarter that GDP again came in at 4.9% annualized, which is really hot. I mean, that's really high, and would lead a lot of people to believe that the economy is not slowing down and that inflation is not on its path back down to 2%. So there's a couple of things we have to look at, which might provide some insight into what the Fed is looking at. Okay? So first of all, we should be aware that the S&P 500 has had a considerable correction over the last few months, right? It dropped about 11%. Now, we said this was a likely correction. I think I said 5 to 10%, so it actually went down more than I thought it would. We said about a 5 to 10% correction is in the cards as you get into Q3 of the pre-election year. So given this correction, that might have the Fed at least somewhat cautious, right? Because there's not yet a guarantee that we get that Q4 rally, right? The Santa rally that a lot of people are hoping for. Now, there are other reasons to think that we might. For instance, just recently Yellen came out and entered shorter duration than the market was expecting. And so that's theoretically a tailwind for stocks and bonds. But there's also headwinds as well. And I mean, that could, for the market, and it could include sort of the labor market cooling off and that sort of stuff. So then the question is what's more important here with the S&P? And this is what and again, I don't know how it's going to play out. Are these sort of these higher lows? Is that what you focus on? And is that the bigger trend? And if it bounces up into Q4 and takes out these highs, does inflation go back up and then make the Fed's job harder? Or is the more relevant trend the local lower highs and lower lows, right? Because it's also up at a pretty important level right now around that 200-day moving average. So the 200-day SMA is at 42.43, and the S&P is currently at 42.37. So it's not, it's really not that, it's basically right at that 200-day moving average. Now, one of the things we said in one of our recent videos on the S&P is that there's a good chance we will get this bounce. And then the question to look for in terms of the sort of the relevance of a Q4 rally or the sustainability of it is can it take out this prior high, or does it just end up being a lower high? If it can take out this high, then that at least gives some credence to the idea. If it just ends up being a lower high, then the status quo, unfortunately, remains unchanged, and it is still a downtrend until proven otherwise. So there could be some elements of the fact that the S&P just dropped 10%. If the S&P were at 4,600 and GDP were at 4.9% and of course CPI at 4.1%, then perhaps the Fed would have hiked again, but they didn't. Okay, and he did say a lot of other things. I mean, he said that one thing he says is evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. He always leaves it open to further tightening of monetary policy, right? He always seems to say that there could be another rate hike, but I don't know that I believe him. And I don't think the market does either. I think the only way we get another rate hike at this point, this business, not that we won't get more rate hikes in future business cycles, we could be in a period of just where we see higher interest rates for years, higher lows and higher highs. But I don't necessarily believe that they're going to hike again. At this point, what would change my mind, though, is if the S&P starts to get going again, and if it takes out these highs over here, if you start seeing inflation start to move back up, then yeah, rest assured, they're going to have to hike again. But he did say something about that as well. I mean, he talked about how miserable that would be if they basically ended up having to go in that direction. I think he said, let me see if I can find it. Yeah, I'm not really seeing it right now. I'm not really seeing it right now. I mean, he did say everyone has been very gratified to see that we have been able to achieve pretty significant progress on inflation without seeing the kind of increase in the unemployment that is typical of rate hiking cycles like this one. This committee is not thinking about rate cuts at all. The committee is not considering changing the pace of the balance sheet runoff. Okay, so I think here it is. Yeah, here it is. So he says, if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that is really bad for people. Inflation will be both higher and more volatile. That is a prescription of misery. We are committed to not letting that happen. So I think basically what they're saying is, I think Powell thinks there's a good chance they're at sufficiently restrictive levels to slow down the economy, but he's not willing to forego the idea of another interest rate hike. So some of the pieces of evidence that suggest that the economy is slowing down, one is coming out of the Atlanta Fed. So if you look at the Atlanta Fed, this is, of course, they were predicting pretty high GDP throughout the entire last quarter, and they ended up being pretty accurate about that. And last week, sort of the expectation for real GDP in Q4 was 2.3%. But today, it came in at 1.2%. So this is a big difference between, 4.9% last quarter and 1.2% so far this quarter. Now, this quarter, basically just got started. So a lot can change. If we fast forward another month or two, this estimate could be right back up to 2%. It could be at 3%, or it could be below 1%, right? But this at least does show some evidence that what we saw last quarter could be sort of the peak of the no landing scenario, right? And I think a lot of that was inventories as well, so it sort of pulls forward some of that GDP that might have otherwise been pushed out later. It could be companies are trying to lock in lower rates because, again, the long end of the yield curve went higher. Remember, as the long end of the yield curve went up, it makes it so that the cost of capital is more expensive, and it could lead to companies trying to secure inventory before the cost of capital goes even higher. So Atlanta GDP is currently saying, this estimate is at 1.2% for Q4. We'll see how this continues to evolve. And then the other thing that came out today that was somewhat, getting into or at least sort of looking like an economic slowdown was still underway, was the manufacturing PMI. Okay, so this is something that a lot of people follow, and it basically just is showing you there's a lot of different things you can look at, but the manufacturing PMI came in at 46.7 from 49 last month. So that's in contraction territory. New orders came in at 45.5 compared to 49.2. Now, these numbers probably don't really mean anything to you. We don't really talk about these numbers that much. I probably mentioned them a couple of times, but a lot of these sort of came in below expectations. So instead of just looking at numbers on a table that don't really tell you a whole lot, we can go look at a chart, right? So this chart is showing the ISM Purchasing Managers Index PMI, and you can see this is what it looks like, going all the way back, decades, right? So over the last couple of months, it was starting to go back up, okay? And this potentially was sort of corresponding to this sort of like this peak no landing scenario where everything is fine and the economy is not slowing down. This sort of deals a huge blow to that narrative, right? I mean, this came all the way back down, to below 47. And again, when you look at it in the context of history, you can see where it has gone in prior recessions. I mean, in the financial crisis, it was, of course, all the way down here, sort of in the mid 30s. During the dot-com crash, it was in the sort of the low 40s. And during the 1980s, you can see how far down it came, and so on and so forth, right? So you can see that it is getting into some pretty deep contractionary territory. Now, it still is not below where it was earlier this year, but the question is this trend going to continue? So, if the Fed is sort of looking at what's going on in sort of new orders and manufacturing, and of course this came out today, so it's not like they necessarily base their decision on this, but there is some evidence, right? There's some evidence that the economy is slowing down, and there's some evidence to suggest that this rate right here of 5.5% is sufficiently restrictive to slow the economy down. And I think the Fed is trying to avoid going too high and potentially breaking something, okay? So they're proceeding cautiously. I think he even said something to that effect, that they're proceeding cautiously or carefully or something like that. So I suspect that unless there's like a major rally by the S&P or unless inflation comes in way over expectations, I suspect that this is the terminal rate. And we said this could be, 5.5% would likely be the terminal rate. We said that over a year ago. So now the question is how long can they hold here? Okay, how long can they hold? A lot of times the S&P rallies when the Fed pauses, right? A lot of times, not always, but a lot of times. But if you pull up the S&P, right? So if you look at this pause over here in June of 2006, you can see that marked a low on the S&P, and then it rallied for about a year, and then the Fed started cutting rates, and we got this pretty nasty financial crisis, right? If you look over here, once the Fed paused, the S&P got a nice little pop. It didn't last very long, right? It lasted, maybe about 3 months or so before it started to fall back down. If you go further back, the Fed paused here in 89, right? In February, looks like February of 89, they hit the terminal rate at that hiking cycle, and then the S&P sort of rallied from February until August or so, right? So there's plenty of examples where once the Fed hits the terminal rate, the S&P rallies. But when you look at this cycle, you see the opposite, right? When the terminal rate was hit, potential terminal rate, that's what marked the high for the S&P, right? That's what marked the high. You can see, right? The terminal rate was hit. That's what marked the high. Now, we've talked about this potential scenario before where the market is sort of treating the shift from 75 basis points to 50 basis points as what it normally does during a pause, right? So when that happened in sort of late 2022, that's when the S&P got a pretty significant rally. But then when the Fed hit this potential terminal rate, which is no guarantee again to be the terminal rate, but when they hit it, that's at least what marked this local top on the S&P 500. Which again, we just looked at the last several business cycles, and we showed that normally when the Fed hits the terminal rate, the S&P rallies. So it could be a couple of things. It could be the market has been unsure if it's actually the terminal rate or not, and that could be one of the reasons why Powell keeps saying, hey, holding another rate hike over our head because maybe he doesn't want to give the indication that it's a pause to try to sort of keep the markets at bay. But there's also this other potential reality that that the markets already know, what needs to be done, and if the terminal rate is already here, which is what the bond market thinks, and it hasn't gone up yet, then perhaps it's just another sign that we're sort of just one step behind. One thing about this business cycle that has been very interesting is that normally the Fed raises into a market that is going up, right? So if you look over here, when the Fed was raising throughout 98, 99, and 2000, the market was going higher. Same thing over here, right? During the financial crisis, or the lead up into the financial crisis, right? The market was going higher during that time. And then the Fed started cutting rates, and then the market ultimately went a lot lower, right? So then you look at it today and you're like, wait a second, that doesn't look like this business cycle at all. In this business cycle, the Fed started raising when the market started going down, right? So it's it's the ordering of this is different than it has been for the last several business cycles. And I think a lot of it is due to how slow the Fed was to start raising rates. Arguably, they should have started raising rates a full year earlier than they did. I mean, with how much the markets were moving up over here, it's sort of a wonder why they kept rates as low as they did for as long as they did. And perhaps you could easily make a case that they should have started raising, back in early 2021, when it was clear that the economy was doing just fine and was adapting to sort of the new normal. But they didn't. They started raising very late. The market went down as they were raising. The market found this low around the time that the Fed shifted from 75 to 50 basis points. It has then found this local high in the summer once the Fed hit 5.5%, so in July. And ever since then, the Fed has been holding rates steady, and the S&P has been dropping. Now, we also know that this has been a pretty seasonal correction for the S&P, right? That's not to say that it can't go higher. It could. If you go look again, and we just showed this yesterday, but if you go look at at year-to-date ROI for the S&P 500, what you'll see is that this has been a pretty normal correction. In fact, it's been a little bit more, but in terms of time, right, it normally tops out over here, and then it sort of slowly fades into September, October, and then sort of chops around in November, then sort of goes back up a little bit in December of pre-election years, on average. That's what it normally does. So I guess the thing to consider is that what happens, right? Does the S&P catch a bid here? Okay, I mean, I know a lot of people are bullish right now, and I'm not saying that the market can't go up. I mean, we said there's going to be a correction. Corrections don't last forever. It's certainly possible that the market catch a bid, but especially given Yellen issuing shorter duration than the market was expecting. So that basically, if I sort of explain it a little bit, I think a lot of people were expecting 30-year. It ended up being 2-year, and now there's not as much pressure on the bond market. There's not as much pressure on the stock market, because and you can see, if you were to go look at at the 30-year, I mean, it's basically falling off a cliff here, at least in the short term, right? It's falling off a cliff. 10-year, same thing, right? Which is why TLT is potentially forming a local bottom, right? So, if you go back and look at the S&P 500, if you guys remember the last few months, right? Like, so many days, the long of the yield curve was going up, right? And as long as that was happening, the equities were dropping. But if the long of the yield curve is going down, then theoretically it reduces the pressure on equities. So that's the thing. A lot of people are bullish right now because of that. So the question is despite all that bullishness, can the S&P put in something other than a lower high? If it can, then great. That means there's room for it to run. If it can't, it might mean that there's another reason that the long end yield curve is going down, and it's because the Fed has gone too far, and the current rate is sufficiently restrictive, and it's slowing the economy down very quickly, right? There's a chance that that is the case, right? That it's slowing the economy down very quickly, as you can see in the PMI, and as you can potentially see in sort of the projections for GDP in Q4 that are already starting to sort of get revised to the downside now. Annualized only at 1.2%. Still a long way to go before we have a realistic guess as to what it's actually going to be. You can see blue chip consensus is now expecting it to come in below 1%. I've watched this thing like a hawk for the last year, probably 2 years, 1 to 2 years. And the more often than not, the Atlanta Fed is pretty close. So I would follow that one. A lot of times the blue chip consensus just sort of goes to wherever the Atlanta Fed is sort of projecting it. I mean, right now it looks like the Atlanta Fed is coming down to where the blue chip consensus is, but we're also relatively early in the quarter, so you kind of have to give it a few weeks before they have like a pretty good estimate. But what we have seen is that the Atlanta Fed does do a pretty good job. So I will still defer to their projections for Q4. So I think the thing to consider, and I know a lot of people are wondering, well, how does this affect the market? How does this affect Bitcoin? How does it affect altcoins? All that sort of stuff. In the short term, over the last few months, the long yield curve going up, increasing the cost of capital, has been a burden on companies. And that burden on companies has probably led to cost cutting. And I think it's also led to some weaker demand, right? Now, that stuff doesn't show up immediately. Okay, there's lag effects to it. So you could start to see the effects of all that. It could be this quarter, it could be Q1, it could be Q2, but there's lag effects associated with it. One of the things that Powell has said, and I try to make sure that I'm not sort of falling into this trap, but he says, everyone has been pretty gratified to see that we've been able to achieve pretty significant progress on inflation without seeing the kind of increase in unemployment that is typical of rate hiking cycles like this one. So I have to ask myself, is this time different, right? Is it different? And the rate hiking cycle will not have a material impact on the labor market? Or is that part of the business cycle still ahead of us? If you go look at interest rates, right? If you go look at interest rates, normally sort of the ebb and flow of this is the Fed raises, holds, and then cuts into a major recession where the stock market drops a lot, right? Same thing over here, right? Raise it, hold, and then cut a lot as the stock market plummets. Raise, hold, cut as the stock market plummets. Right? So you can see 3 clear cases where that happened. So then I look at this case, we look at this business cycle, and I say, all right, well, up, hold. What happens when they cut, right? I mean, does the stock market do something different this time? Or does it do what it always has done when the Fed starts to cut? Now, why does the Fed start to cut? It's not because the S&P necessarily, well, it sort of is, but it's because normally what happens is they've done too much damage to the economy and it's slowing down beyond what they wanted it to slow down. So for instance, if 5.5% is too restrictive, then you would expect to see things like the PMI in coming months to continue to print in contractionary territory, right? Where it's still going lower, right? So this is the ISM Purchasing Managers Index. This one over here is new orders, right? So you can see that this one also fell a good bit. I mean, it had been moving up generally over the last few months, but this has been a pretty big drop that basically has gone lower than the prior 4 months. So again, that's the question: is have they done too much? Like there's an argument to be made that if the economy is slowing down, they maybe would have achieved the same thing at 5.25%, right? And perhaps 5.5% wasn't necessary. But as they hold at 5.5%, we will see if the economy can manage it or not. And if the economy can manage it, then that likely means that there will be more rate hikes eventually. They might not come until 2024, but that means there could be more rate hikes eventually if the economy manages it, because that could mean that inflation just comes back in and that inflation expectations become entrenched. If the economy can't handle it, if the economy just simply cannot adapt to 5.5% after being addicted to basically 0% for so long, then you would expect to see all these things continue to print contractionary numbers for months to come. And if that's the case, then it means that the labor market would start to take a hit. I believe they mentioned labor a few times. I was reading this report. Demand remains soft, but production execution is stable compared to September, as panelist companies continue to manage outputs, material inputs, and more aggressively labor costs. So yeah, I mean, that was basically, one of the things that you can start to see that some of these companies are starting to consider is managing their labor costs to account for slightly lower demand. I don't think that it's necessarily recession. It doesn't necessarily mean that it has to be a recession just yet. But I think the issue is, does the unemployment rate start to turn higher, over the next few months? Because so far it hasn't. So far it really hasn't. I mean, it has moved up a little bit. If you were to go look at, I can find it. So unemployment rate, right? I mean, it's at 3.8%. And really, I mean, ever since they got this bounce off of 3.5, that's where the market has started to come down. Remember, the market, the S&P drops and will hit a low before the unemployment rate peaks. So if the unemployment rate is in the process of moving higher, then the S&P could continue to go down, right? That would be the thing that would weigh on it more than anything else, would be if the labor market starts to show signs of weakness. So I think that, and by the way, we're getting another report on the unemployment rate on Friday, right? So we should know soon enough if it's still holding. I mean, it looks like consensus median forecast is 3.8. So if it's at 3.8, that means the labor market is still sort of holding steady, right? If it can hold at 3.8, if it goes to 3.9 or 4%, 3.9 probably people won't care. If it starts to print a 4 handle, it might start to raise some eyebrows, right? So the unemployment rate has been relatively low, and it hasn't made that move yet. Again, if you were to go look at interest rates, let's overlay interest rates with the unemployment rate, right? So you can see that what causes the Fed to cut, like here, what causes them to cut is when the unemployment rate is going up, right? So that, I think, is the only way they're going to start cutting, is if it starts to have an effect on the labor market. But the labor market hasn't really made that move yet. It's still at 3.8%. And if you look at some of the numbers, right, some of the more detailed numbers, right, if you go look at initial claims, it's still printing low levels. I mean, this is still at only 210,000. Pretty low level. Continued claims is starting to show a little bit more worrisome numbers here, right? It's starting to go higher, potentially bottoming out here in September, just like it did last year. Okay, so if that continues to go, the reason why continued claims is important is if you go look at unemployment rate versus claims, right? So if you look at continued claims versus the unemployment rate, right, you can see that they sort of, I mean, if continued claims is going higher, which is the green line, the blue line, unemployment rate, tends to follow. And then continued claims tops out before the unemployment rate does, right? So you can see it pretty clearly. Oftentimes, not every time, right? Here's an example where it doesn't in Actually, no, it still did. It still topped out just before it, maybe just like a month before it, or 2 months before it. But that's the thing: is continued claims going to start leading the unemployment rate higher? And if it does, that could lead to sort of the Fed having to figure out well, how long are they prepared to hold rates at 5.5% if it in fact is sufficiently restrictive, right? Because again, at this point, there's no clear indication that inflation is back down to 2% or is even necessarily heading in that direction. If we just pull back up inflation, core inflation, I mean, it has been moving down, but there's no guarantee it's going to continue moving down if markets start to pop off again. And speaking of, I mean, crypto has been moving up a lot recently. Bitcoin is almost at 36K. Bitcoin has had a pretty aggressive move to the upside here. So, and look, I don't know where it's going to stop. I mean, you could always make a case at any point. I sort of assumed the yearly high was in. I know I said Bitcoin could go as high as 35K this year early on, but I sort of rescinded that, and now, I mean, it's basically gone to 36K. So don't ask me where it's going to stop. You could always make a case at any point, and I do know it is starting to come into some of these macro trends, but it's still, I mean, who's to say, right? I don't know. I'm sort of looking at this trend line here, but look, we've seen plenty of trend lines get broken, and this one could easily get broken as well. If it doesn't get broken and it gets rejected, then it still doesn't mean that it can't form another base, just like it has previously. I'm sort of under the assumption that these lows don't get taken out until a recession is actually underway, right? It's sort of where the secondary scare comes from. Is it, it basically makes it people think that it can't ever go down, and then it just sort of takes out all the lows. Not necessarily all of them, but some of them. So, I mean, you can still have a case where Bitcoin has this run up, holds for a while, and then gets the secondary scare of a recession, and we have to deal with that either later this year or early next year. So that's basically what we're looking at here. Obviously, the altcoin market has popped off a little bit here recently because Bitcoin went up, right? So I've said previously, for pre-halving years, exposure to crypto, in my opinion, should be basically limited to Bitcoin. That's not to say that altcoins can't go up. As you can see today, they have. But it's just to say that if altcoins do go up, it's only because Bitcoin went up first, right? And the dominance should go up no matter what. And that's been the case, right? The dominance is now at close to 54%, right? I mean, a lot of alts put in new lows against Bitcoin last week. ADA Bitcoin put in a new low last week, right? Just last week, a new low this cycle. AVAX Bitcoin, a new low last week. Dot Bitcoin, a new low last week, right? And the same thing can be said for a lot of these altcoins. Not all of them. Some of them have been strong. But I always said some of them would be strong. So the majority of them have been weak against Bitcoin. And that's why, in pre-halving years, Bitcoin, if you want exposure to crypto, Bitcoin tends to be where you want to be. Because if it goes up, all Bitcoin pairs go down. And if it goes down, all Bitcoin pairs go down. If Bitcoin holds at a certain level, yes, alts can run. But the only reason the alt market's up in the first place is because Bitcoin went there first, right? And we've talked about that a lot. So that is still my assumption. I think that, for the people that are wondering when alts can actually start to aggressively outperform Bitcoin on more than just like a 2-week period, right? Normally when you get into the halving year, you start to see those sort of that fundamental difference, right? Like look at Dot Bitcoin. I mean, this is the chart, and I mean, I know a lot of people are excited, and Dot's back at $4.50 or almost $5. So I'm sure it's relieving for people to see that, right? But look at its Bitcoin pair. Look at its Bitcoin pair. I mean, this year it's down 48, 49% on its Bitcoin pair. You would have been so much better off just sticking with Bitcoin in the pre-halving year and forgetting about a lot of these altcoins and then just starting to get interested in them in potentially the early part of the halving year, right? What would you have missed out on? It's down almost 50% against Bitcoin this year alone. And it also dropped 54%, 55% last year against Bitcoin. Same thing could be said for a lot of the altcoins, right? ADA Bitcoin dropped 47.5% last year. It's dropped 41.5% this year so far. Right? So, I know, I've dealt with this countless times over the last 2 years where altcoins start to run. There's this FOMO that comes back. But I'm not trying to say they can't, right? It's just that it still doesn't negate the fact that if you had just stuck with Bitcoin, you would have outperformed most of the altcoin market, right? That's a fact. We can cherry pick a few alts here and there that have outperformed, but I always said there would be some. So, I still look at this and I say, well, how does crypto react to, if we go into a recession, right? How does crypto react? And it's probably not good, but again, timing is everything. And who knows exactly when that's going to happen. The process could already be underway for the S&P if in fact the highs are in and it doesn't go above the summer highs. We kick the can down the road, and we sort of see it happen in 2024 or something. I don't know, but hopefully these videos are useful to you guys. I know a lot of you guys just want me to make videos on altcoins and pump them up and all that sort of stuff, but I have to look at their Bitcoin pairs and recognize that they haven't collectively yet reversed trend. It doesn't mean they're not in the process of it, but like looking at total 3 minus USDT divided by Bitcoin, it literally just put in a new low this cycle last week, right? And I keep going back to this like every few months where the altcoin market is pumping against Bitcoin and people get excited. And then I go back and look at the chart. I'm like, well, it just put out a new low against Bitcoin like last week or last month. And I keep telling myself that like again and again and again. It keeps putting in new lows against Bitcoin. Why should I assume this time is different? Now, it's always possible that this time could be different, right? It's always possible. Or maybe, just maybe, it's not. And perhaps that even if they go up on their USD pairs, they could still simply lead on their Bitcoin pairs. And again, it could be because Bitcoin goes down and they get wrecked. It could be because Bitcoin goes up and they get wrecked. But that was always the point, that altcoins get wrecked on their Bitcoin pairs no matter the direction of Bitcoin. No matter the direction, whether it goes up or down. So a Bitcoin heavy portfolio in the pre-halving year tends to do better than an altcoin heavy portfolio. Unless you're 100% into one altcoin that only, that basically just went up against Bitcoin this year. And there's a few of them. I know, because you guys are constantly reminding me of them. But I did just want to sort of sprinkle in a little bit of crypto acknowledgement, because I know that if I don't, the pitchforks come out. Pitchforks already come out anyways, but I did want to at least talk about it a little bit, because I do know that Bitcoin has sort of run up here over the last few days and has sort of gone reverse to the stock market over the last few months. But anyways, that's where we are. That was sort of your summary of the FOMC and some of the macro stuff that we're looking at. We're going to be getting more macro data. We're going to be getting initial claims and continued claims today, in fact, on Thursday, because it's already after midnight here. And we'll be getting, another jobs report with the unemployment rate and everything on Friday. So I imagine the markets will react to that as well. So we'll see what happens. Thank you guys for tuning in. Make sure you subscribe, and I'll see you guys next time. Bye.